Hello everyone, I'm Tag
And this is Bob.
and you're listening to Bob and Tag Talk. Before we start the show, I'd like to point out that the topics discussed on Bob and Tag Talk are for informational purposes only. So please do not take this as investment advice. We urge you to do your own research before making any investment. So I thought we'll talk about the basics of the terms that come under stocks and mutual funds, that is share, SIP, SWP, etc. So I thought we'd start off with talking about a share, and I'm really interested in talking about this because I was having a conversation with a couple of my friends where we were they did not know much about investing, and they were asking me to explain what exactly a share means. And this is how I explained it to them. So you let me know if what I explained to them is right or if there's something that I've missed. So how I explained it to them is like, okay, imagine a company as a building. That building is made up of so many cubic blocks.
Yes.
Let's say it's made up of 500 cubic blocks.
Yes.
And the company decides to give that 500 cubic blocks as something called shares to the public.
Yeah.
So if we buy one of those cubic blocks, let's say it means that we own one share of that company.
Yes.
And
Yes.
and that cubic block itself can grow to give us profits. And if you want to buy more shares, it's equivalent to buying more cubic blocks.
The concept is very similar to apartments.
Okay.
So instead of, let's say, you cannot afford, let's say, 500 square feet, so not 5,000 square feet
Right.
land.
Right.
So what you do is there are a group of people who join together who buy that piece of land, and everyone owns like 1% or 5% or 10% of each, depending on the number of people. So everyone pulls in money together, buys that particular land, and when the land appreciates in values, so each one's share of the investment increases.
Right. Okay.
So the proper definition of a share is basically when a company is trying to increase or raise money, they will come to the market and then they will announce that they want to, let's say, sell 25% share in their business. So let's say, so what they will do is they will say that, okay, total number of shares of this particular company, they will say it as, let's say, 10 lakh shares.
Okay.
And they will probably are willing to sell 1 lakh shares in the market.
Okay.
So they will come up with an IPO. That is an initial product offering.
Initial product offering. Okay.
Yeah, it's similar. I'm not sure if the exact term is right, but it's
Okay.
an IPO.
Got it.
Yeah. So once they make the product offering, mostly it will come through banks. So one of the institutional banks like HDFC, Kotak Securities, or Morgan Stanley, or any Goldman Sachs, any of those foreign banks also can participate. They will announce it and they'll come up with something called as DRHP, a draft red herring prospectus. Basically, it's like a prospectus saying what's the business of the company, where do their profits come from, what are their risks if in the business, and something like any governmental, where do the profits come from?
Okay.
Do they have government contracts? Do their profits come from the government, or do they actually sell international? From which region do their profits come?
So basically a complete background check.
It's something like a background check. Yes.
Okay.
So that's it's like a template format with most of the details.
So if the company decides that they want to open their shares to the public
Yes.
market, so they will start off with something called an IPO.
Yeah, initial public offer.
Initial public offering.
Yeah.
Okay. So when they do the offering, there will be an entity that does this intensive background check on them.
Yeah.
What is that called?
It's draft, not a background check. Basically, banks are the ones that are offering
Banks. Okay.
these shares to buyers.
Oh, okay.
So they'll
okay.
prepare all this documentation with the SEBI, that is the exchange board. So they will prepare all the details. Make sure they'll provide all the details to the public. So the public needs to go through these documents and then they will need to probably assess whether they're willing to buy some shares in this company or not.
Oh, okay. Now I understand. Okay. Yeah, I've gotten.
Yeah. So the most of the important things in the thing, what are the risks?
Hmm.
Where do the profits come from? And like are there any international risk, domestic risk, supply risks? Do they have suppliers? And if there's any problem, there could be some disruptions. They have to try to provide some details like that. And the future growth opportunities, like where they can grow, and some details like that. And in the past 2-3 years, how they have been managing the company, and things like some details will be provided. It will not be exactly. For example, it'll be like what do you say? A little bit positive. I mean, they can build a positive picture about their company and then sell it.
Right.
But we can never be sure that it 100% is true.
Oh, okay.
Everything has to be taken with a pinch of salt, basically.
Okay. This is because the banks they themselves are providing all of this information. We take it with a
We
grain
take it
of
with a
salt.
grain of salt. Yeah. So once they provide all these things, then public can bid some money for each of the shares. So for example, they'll share the shares in lots, like 1,000 shares in one lot or 2,000 shares. There's 1,000 shares, they can say 15,000 minimum, and so on. So they can fix some price for each of the lots, and people will bid.
Right.
So highest bidders tend to get it. Sometimes what happens is you may not get highest bidders. Some people it will be a range.
Right.
So, and depending on the amount of money that you're putting, they will select who will be allotted.
So
basically like sometimes it's
auction.
like a lottery.
Yeah, auction or a lottery.
Auction come lottery. Yeah.
That's the first thing I thought of when you were like talking. Okay, got it.
Yeah. So once all the public have put in their bids, there are some members of the public are allotted the number of shares, and then eventually this company is listed on the stock market. Once it is listed on the stock market, there will be a minimum period in which people cannot sell.
Okay.
At least the owners cannot sell, or not necessarily owners. For example, some companies may have some employees who own some stocks in these companies. So there will be a minimum like 30 days to 60 days, some period where they cannot sell. After that period, the employees can sell their shares and they can exit. There will also be some initial investors. Like, for example, there may be something like institutional investors, or there are like mostly these days, there are a lot of companies like Sequoia Capital, Tiger Capital, and so many other companies who invest in these startups, and then eventually they exit during these IPOs.
So when you say institutional investors, you mean other
Institutions,
companies or something that
banks, companies, institutions, can be anything.
Okay.
It can be anything. For example, Google can invest in some Indian company because they feel that it can grow, things like that. Like Dunzo, something like Dunzo. Google owns a little bit piece of Dunzo, or something like that. Or Flipkart, Walmart was initially they bought a little bit of shares in Flipkart, but these are all private shares. They are not public yet. After they are listed in the stock market, they are public.
Okay.
Usually these IPOs are an exit for initial round of investors. Usually we call them Series A investors or something like that. They usually get out. They have invested in that company. They have grown that company to a particular point. After that, they have decided to make an IPO. Now they will sell their shares. These shares will go to public.
Okay, that's interesting. I didn't know that the initial investors would like sell their stocks. Is it necessary that the initial investors
not
sell
necessary.
their stocks? Okay.
It's an optional.
Okay.
Yeah.
So let's say you've like invested in a couple of shares for a good amount of time, and you it's going well. It's like growing, and you assume that you will get some profits out of it.
Yes.
So how do these companies give out profits to users?
Okay, so mainly the investors, right? So let's say, for example, you can take any company that has been listed in the stock market for 20 years. They have been profitable, let's say, for the past 15 years. So how do the shares are distributed to the investors? Mainly the public investors. So there are like different modes of distribution of profits. Most primary thing is a dividend. A dividend is, let's say, for example, every time you have an annual board meeting of the company or an interim board meeting, every 3 quarterly or half-yearly meetings. So they will decide that, but they have made so much profits. They will have an audit of their profit results. They will share it in the public space and then also to the regulators. And then they will decide that this much percentage of the profits they are giving away as dividends. So they can say, let's say for a year, they can say 5% of the profits, they will give it out to the investors.
Okay.
So 5% is 5% of the share price. It could be.
Okay.
Or generally what they will say is, let's say for example, when you're going with an IPO, you have a face value of a share. So this is a common share. So the face value of a common share, they can fix it to 1 rupee, 5 rupee or 10 rupee. So if it is 10 rupees, face value is 10 rupees, then if they say 3 rupees per share, they're giving it as dividends.
Right.
So if you own 5,000 shares,
Right.
so 5,000 into 3, that is 15,000, you are getting it as dividends.
Okay.
So this is for 1 year. This is like a year and dividend. Interim dividends also possible. A quarterly dividend, half-yearly dividend can also be announced by the company.
Right. And this is all depending on the company. If the company decides to give this much, their performance and if they have made profits and they decide to give these dividends.
The same thing happens in generally if you want to take an analogy, if you're an employee of a company,
Right.
if you have a component called variable pay, your variable pay is depending on the performance of your division or your company.
Got it.
And then once your company performs really well, then your percentage of variable pay 100% they give, or sometimes they even give 120, 150%. Performance is not good, you may not get you may get a little less.
Okay.
So but here in this case, in the case of public companies, only if there are profits they can give dividends.
Okay.
If there are no profits, you are going under loss, you cannot distribute generally. There's no money to distribute. It's all about cash in hand, how much cash each of the companies.
Interesting. So let's say you've made whatever you think that you can make from this stock, and you want to sell this stock, and you want to get the money that you've invested plus the profits and whatever it is that it comes. So how would you do that?
So thing is, let's there's an important distinction here. There are different companies they are like growth stocks. Growth stocks don't give out dividends at all.
Right.
So they expect that the share value will keep increasing, and any time an investor wants to exit, he can or he wants some money, he can sell some of his shares and get back his money. So let's say 10 years ago you bought some 5,000 shares.
Right.
This value was, let's say, 10 rupees.
Okay.
So you spent 50,000 rupees. Now the share is 100 rupees or 200 rupees. So how much ever money you want, you sell this few number of shares and get some money back. Or if you want to completely exit, you sell all the shares. So this is one way. If the company is not giving dividend, this is the only way to exit.
Okay.
There are also other things like the company announces buyback. So the promoters of the company or the owners of the company will buy the shares back from the public at a fixed price or a fixed price range. It depends. So the investors can participate in this buyback program. They can sell their shares directly to the company instead of someone else.
And this means that the company would get a share of their equity back.
Exactly. So they're increasing their shares in the ownership.
Oh, okay.
So that is actually a good thing. So, it's a good thing because the owners of the company or the promoters of the company think that the company's share price values in the future is going to be very high. So they can, some shareholders, if they want to exit, they can give the exit, they can buy back the shares from the public, and they can increase their shares so that they have complete control over the company and future profits.
Right.
So generally buybacks are a little bit positive, but it can be used negatively also. Probably that is a tale for another day.
Okay, fine. Alright, so that's a brief introduction on stocks. There's still one component about stocks that we have not discussed, which is tax. We'll probably come to that towards the end. Now we'll jump into mutual funds. So specific terms in mutual funds, what you need to know, we'll discuss about.
Yeah. So just like stocks, like for example, some shareholders don't want to directly invest in stocks, so they can go with some mutual fund houses, like a very popular like HDFC mutual fund or ICICI mutual fund. Any investment banks also, they have their own mutual fund. So these companies who invest in shares they have a fixed plan. This is the plan they're going to, like for example, they will go 60% equity, 40% debt funds, or banking funds or something like that, government funds and so on. They'll have a systematic plan that this is what we are going to do, this is what we're going to invest in, this is the fund manager, and they are going to ask money from different people. They're going to collect money and they will invest in shares on these companies on all their investor behalf. So this is a mutual fund. So again, so they have a fund manager. So again, just like how we have an IPO for shares, we have something called as a new fund offer in mutual fund.
Right.
For example, HDFC can come with something like a flexi cap mutual fund. They are announcing this new fund.
Okay.
They will give you time, let's say like this mutual fund is going to be coming from January 30 or something like that. Fix a date. Within that date, people can put some money into it. They'll they'll announce it basically. And there are two types of mutual funds. One is open-ended and closed-ended. Most of the mutual funds these days are open-ended, so we can just say these are the commonly used mutual funds. We can go ahead with that.
Okay.
So when they announce this new fund offers, so immediately people will start putting money.
Okay.
Basically, you're writing a check and giving to that HDFC mutual fund. You're giving it to them, and then these fund managers will invest in these stocks. Let's say they'll say that 10% of the stocks they'll invest in IT companies, 20 to 30% they will invest in manufacturing, cement, construction, and all those things. Then there's some of the things they'll basically sector based they can invest in.
Okay.
And then some money they will put it in government companies like Indian oil companies, or it can be electricity companies,
Right.
any utilities. They will split everything. They'll diversify basically. So mutual fund, the main thing about mutual fund is diversification, and the fund manager of that mutual fund takes care of it.
Okay. You mentioned something that there's open-ended and closed-ended, and then most mutual funds today are open-ended.
Open-ended.
But what is open-ended and what is closed-ended?
Open-ended means anyone can invest anytime. They can come in at any time. So closed-ended means like once the new fund offer is completed, people cannot buy into the mutual fund.
Okay, so that means once it's closed, it's not open to the public anymore.
It's not open to the public. It will only be like, for example, if someone is exiting, then the fund manager has to give some money and give an exit to that particular investor.
Okay.
So the thing is, new investors are not encouraged in closed mutual funds. Open mutual funds are like anyone can invest anytime, anyone can withdraw anytime. It is a little bit flexible.
Are there any mutual funds today that are still operating as closed-ended?
I mean, yeah, there is, for example, even HDFC has its own closed-ended mutual funds.
Right.
They'll have something like, usually closed-ended mutual funds in India that I have seen are like, they'll come with like some series number, some INC, blah, 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 some number. This is what they're opening. And we are promising 6%, 8% returns. They'll have a front offer like that. But I don't think that is very popular right now, because people want flexibility. People want, not generally, I think closed-ended mutual funds are very like high institutional or large investors, probably a long-term view. Probably, I don't think like common public will generally prefer closed mutual funds. So just like what we discussed with shares, there are also a lot of terms in mutual funds that are very common. One is a systematic investment plan. So that's a plan for investors, investment plan that they can do monthly regular investments into the mutual fund.
So it's like an automatic thing that gets like
Yes,
deducted.
it's an automatic plan. So once you set up, let's say every month 5,000 you want to invest in a mutual fund, you just decide it, you set it up, and every month it will keep deducting, and they'll keep buying shares on behalf of you.
Systematic investment plan.
Investment plan.
Okay.
And then generally in mutual funds, you don't get dividends or anything like that. So basically the mutual fund house will get the dividends, and then they will reinvest the dividends into again shares.
Okay.
So that is when the value of a mutual fund keeps on increasing. So if you get dividends, or even if the share price increases, the value of that particular mutual fund will also increase. So how they keep track of it is called, it's a term called NAV. It's called as net asset value. So basically, just like how you have shares, a number of shares in a company and so on, here once you have a pool of money, mutual fund has a pool of money, they will split it into units. So let's say, for example, 1 unit is 10 rupees. It's the initial thing. After that, as when the prices increase, they will say 1 unit is 11 rupees, 12 rupees. So they will keep an internal track of it. They will publish data about it. What is the net asset value of a 1 unit? So that's even when you buy 5,000 units or 1,000 units, it will change. The amount of money you put in will be the same every month. The number of units you're getting out of it will be different. It will be based on like the share value increases. So for 5,000 rupees, you may get little less units for the next month. But since you're investing every month, sometimes it goes up, sometimes it goes down. Sometimes you may get more units, sometimes you may get less units. And then it will eventually average out.
Okay.
So this is called dollar cost averaging.
Okay.
It's a term called dollar. Basically, that's the whole benefit of SIPs and mutual funds. Basically, you don't worry about what is happening in the market. You just keep investing month in every day or every year and so on. and eventually the average cost will be average, and eventually after 10 years you will get a good money as a return.
Okay. I have one question. So let's say you're using these investment apps to like check your mutual funds and stocks and everything. You'll obviously be looking at all of these terms, right?
Yes.
And you mentioned NAV. So how is NAV depicted on these apps? Like what is the measurement they use to show
NAV is just like 1,000
a
rupees or
number?
500 rupees.
Okay.
And for your 1 unit. Basically, it's just like 1 shares. You have 1 share in the mutual fund.
Okay.
1 unit is 1 share. That's
Okay.
something
Got
like
it.
that.
Got it.
Yeah. And then again, for mutual fund, there are a lot of expenses that the fund managers have to do. You need to pay salaries to the fund managers, and there are a lot of other expenses for maintaining that particular fund. So for a person, they will take a cut of the profits or of the returns. Sometimes even if it is going under loss, they still have to pay for these expenses.
Right.
So this is termed as an expense ratio.
Okay.
So generally, some mutual funds are really good mutual funds. They have a higher expense ratio, like 2%, or 2% is really high, but yeah, some funds do have 2%. Generally 1.2 to 1.5%. Some mutual funds are like very automatic. They don't have a lot of changes.
Maintenance.
Not maintenance. With fund manager's plan does not require a lot of changes.
Okay.
They have a fixed plan. They hardly change it.
Okay.
In those cases, they'll have a lesser expense ratio. And you have these index funds. Index funds, like basically you have a percentage calculation. Reliance will be 16%, Infosys, TCS, and these companies will be 5%, 6%, 8%. You have fixed percentage.
Okay.
Based on the market cap of the shares and actual indexes like Nifty and Sensex. So computer will automatically maintain these ranges. So all these things have the lowest expense ratios, like 0.2% or 0.3% and so on. So these are the kind of charges that they charge. And generally for systematic investment panel, there is no charges. But let's say, for example, you want to withdraw. So that is called an exit tax or an exit charge. So if you want to completely exit, they may charge like 0.5% or 0.2%, sometimes even more. If you're within 6 months you're exiting, or depending on the time range also, they can decide that maybe beyond 2 years they will say no charge, you can exit any point of time. So they'll have an exit charge as well.
Okay. So there's something called an expense ratio that you'll have to keep in mind, where you'll have to see if it is too much or if it is too little.
Yeah.
And then if you need to like exit from that mutual fund, you'll also have to pay attention to the exit load charges.
Exit load, exactly. It's an exit load.
There's one more thing I wanted to ask you. So there is also a lock-in sort of thing for certain mutual funds, right? That you
Yes.
have to stay for like 2 to 3 years or something like that.
Yes. So there are some government issued, not government issued, basically there are some benefits that you get, like tax benefits. If any of the mutual funds is giving you tax benefits, then they'll have a lock-in period.
Okay.
So within that lock-in period, you cannot sell. Basically, we can, just like that, we can go into taxation part. So we have short-term capital gains, long-term capital gains. So if, for example, government is giving you tax benefits for investing in some mutual funds. So what they are saying is whatever money that you earn from that particular mutual fund is exempt from tax.
Okay.
So exempt from tax, you don't have to pay tax on the profits. So, but you have to stay invested for 3 years.
Right.
So beyond 3 years, it'll get basically automatically, it's for long-term capital gains is not charged. There are short-term capital gains is basically, let's say you are selling some shares. And then within a year or within something like that, within 2 years or something like that, then whatever money you earn, that is, let's say you put 50,000 into these shares or mutual funds. Let's say you get 80,000 rupees after 9 months. For the 30,000 rupees, you have to pay tax according to your income tax slab limit.
And this is applicable for both stocks and mutual funds.
Yes.
And excluding mutual funds that are not tax saving.
Yes.
Okay. Understood.
So anyway, tax saving, you cannot sell it, so you will not come into this problem.
Right.
So all these things, short-term capital gains is that for 30,000 rupees, you have to pay some tax. And basically, if it's like 20% tax, you may have to pay on an average. Some people, maybe it's only 10%, some people it is 30%, depending on the thing. And then long-term capital gains is beyond 2 years or 3 years. Then the taxation is very low. It's only 10%. It will not go more than 10% for long term. So generally, basically, even the government or any of the mutual fund prefer long term investors. So this basically for encouraging long-term investing and
Okay.
avoiding speculation. It's a good thing to have sometimes.
Oh, okay. Okay.
And then every mutual fund will have a benchmark. For example, let's say, for example, index fund is basically the benchmark itself. That is the Sensex or Nifty.
Okay.
But that is, if Sensex or Nifty goes 2% this day today, or it gave 8% returns for this year. So the mutual fund will measure their performance according to the Sensex performance.
I'm not quite sure I understand this. Could you explain it one more time, the benchmark thing?
Basically, Nifty is the benchmark. So
Okay.
Nifty is a collection of 50 stocks, the top 50 market cap stocks in all of the companies in the listed in public.
Okay.
So all these list of things, it will have a percentage weight.
Okay.
So Reliance is 20%, Infosys 10%, TCS 10%, and all other 40 companies will be 5%, 2%, and so on.
Okay.
So it's a collection, it's a basket of 50 companies.
Okay.
So let's say 1 year ago you bought this 50 company shares, the mutual fund of these 50, and that is the index. So after 1 year, basically the value of that has increased to about 7% to 10%.
Fine.
So basically, if you have invested 50,000, now the value is 55,000 or 56,000.
Okay.
So this 6,000 is your returns.
Right. Right.
So the index has performed 6%.
Okay.
So 6% profits or increase in value it has given
and
you.
you're comparing it with that.
So the mutual fund also will have a benchmark to that same index.
Okay. Okay.
So mutual fund also will have their returns. Sometimes their selection of stocks will be very different from the Nifty stocks. So they may have a more allocation in Reliance, TCS, and software companies, or they have more allocation in one specific sector. So they will not have the same companies, or they will not have the same percentage allocation.
Right.
So their basket is different and their percentage allocation is different. So their returns will also be different. So how do you rate whether this mutual fund is good or not? So, or is it profitable or is it not? Or is it giving good returns or not? You compare the return of the mutual fund with the return of the Nifty or Sensex. So for example, if a mutual fund is giving 15%, that means it has outperformed the index by so much. Maybe if the index is 8%, it's outperformed by 7%.
Okay.
So the fund managers are managing the fund really well to generate
this much, so much more
better.
than the
Sometimes it's termed
benchmark.
as alpha.
Oh.
So it's like delivering more than the index or the benchmark. Every mutual fund will have its own benchmark. Or for all equity related funds, it is generally the Sensex or the Nifty is the benchmark.
And the benchmark is different it's done differently for stocks and it's done differently for mutual funds.
No. Stocks don't have benchmarks.
Okay. I misunderstood. Okay.
Stocks don't have anything called benchmark. Is exclusively for mutual funds.
Right. Okay. Yeah. Stocks don't need benchmarks, no, because it's the actual share price. Right.
Correct.
Okay. Yeah. I understood. Yeah.
Just like that. Now, for example, if there are mutual funds that invest internationally also, so their benchmark may be different, but generally for all purposes, it is the Indian stock exchange, that is NSE or BSE's Sensex, that is considered as benchmark for all equity funds. For debt funds, the benchmark will be a little bit different.
Okay. So we've talked about the basics of stocks, the terms needed to sell, buy, and we've discussed the same for mutual funds. I thought we could also discuss about people and the way they invest. That is, different people invest differently. There are certain people who perceive the market in terms of other people's perceptions, and there are certain people who look at it mainly from a numbers perspective. So I just thought how different people might invest differently.
The most common thing that we can say is like there are short-term investors and long-term investors. Long-term investors don't get into these numbers or thing. They look into the company, what business they are in. Do they have really good leadership, executive managers, and do they really manage the company well? And the company's scope in the business, how their competitors are, can they really make profits every year in the next 5 years, 10 years, and so on. And the long-term investors generally invest for more than 5 years. So they look into those kind of parameters to judge the company or to evaluate a company and see for the next 10 years, the next 15 years, can this company be profitable? Is this business profitable? And is this industry profitable, and so on. Eventually, they will just buy the shares and then forget about it.
Right.
Or they can just top up their share. They will not sell unless there is a real crisis in the company, or there is something really going on in the industry which is unsustainable or something like that. And until those kind of scenarios come, they will not sell. But generally, they have a long-term view of it.
So, is it fair to say that short-term investors see the more technical aspect of things, while the long-term investors see the more behavioral aspect of things?
Not true. Behavioral short-term investors also can use behavior as a thing.
Right.
Behavior is what we say as behavior of the market. So generally, for example, let's say we get the news that Delta virus or Omicron virus is spreading fast. So short-term investors can play on these things, can play on these sentiments of general people who are panic and then who sell and exit. So short-term traders can make a play on it. So they can say, or there's a positive sentiment around, like some stocks like electric automobiles are really popular now. So this company, there's a news that this company is starting to invest more in electrical companies. So then suddenly the short-term investors can make a play on it.
Right.
So they can say that, okay, these kind of sentiments, behaviors of other people will trigger their investment strategy for a short period of time, like 3 months or 6 months. There are other things like results, quarterly results. So based on quarterly results also, short-term traders can trade on it. So for example, if a company is, let's say you think that in the next 2 months, the company will announce a dividend. You can buy more stocks. After the dividend is there, let's say the prices increase or something like that, or something else is announced. The company has a new product or something like that. Prices of share will increase and then they will sell it. They'll make a profit and then exit for 3 months period or 6 months period. They can do that. So short-term traders also can be play on these behaviors. But most of things are technical traders.
Right.
They look at charts.
Right.
They look at 50-day moving average, 200-day moving average. What is the price of the stock in the past 50 days? How is it performing? In the past 200 days, how is it performing? So how are the competitors performing? So, and for example, like they will look at specific chart patterns. And then they will say that this chart pattern is basically going towards a particular price. So, or it is consolidating to a particular price, or it is gone beyond a particular price, so it's a little bit safer. So probably it may only go up for some period of time. They make these kind of calls and then they do an investment.
So a long-term investor is more concerned with the organizational aspect of the company to ascertain if
business.
that company can grow or not. Even though they also focus on the technical aspects of all of it.
The long-term investors may not go into technical. When they say technical, it may mean like technical of the chart things, chart patterns, short-term. They may not go into that. They may go into profits, dividends, earnings, and things like that. Basically, all the technical things related to a business or a running company.
The functioning of
a company.
Or how it is being maintained.
Yeah, but generally we don't call them technical, but those are some numbers out of it.
Okay.
We can make price earnings ratio, or we have different ratios, price to book ratio, price to sales ratio. People can look into it, people can have an understanding of the company, but long-term investors can always look into it, but generally they are more broad-minded view of the long-term goals of the company and their long-term investment goals. Are they aligning or not?
So there's something called, based on the terms of investment, there is short-term investors and long-term investors, and based on, how would you categorize this? Based on type of investors, there is behavior, there is technical, and most often it's an amalgamation of both.
Multiple things. It depends. It depends on the strategy.
Right.
Investment
It's
strategy.
not a mutually exclusive thing at all.
Yes, it's not mutually exclusive. No.
Yeah. And I think that's a good spot to end it there. Thank you for listening to Bob and Tag Talk. Please consider following us on our Instagram and Facebook pages for weekly summaries and illustrations of the topics discussed on the podcast. If you found this episode informative, please like, share, and subscribe.